Hyundai is closing a deal to buy SoftBank's remaining 9.65% stake in the robotics firm Boston Dynamics. The purchase price is $325 million. Based on current market estimates, Boston Dynamics is valued somewhere between $22 and $30 billion. At those numbers, a 9.65% stake should cost nearly $2.9 billion to acquire. Comparing the deal against current market rates, Hyundai secures the shares at an extreme discount, generating an immediate paper profit of up to $2.5 billion. This isn't a sudden market correction, but a pre-existing contractual trap locking in a massive valuation gap. By utilizing a specific set of financial options, the automaker is capturing billions of dollars in tech-driven valuation growth for pennies on the dollar. Hyundai is coordinating a dual-purpose strategy designed to automate factory floors while generating the capital needed to restructure the South Korean corporate empire. The mechanics of this arbitrage were written into the original 2021 agreement when Hyundai first acquired its controlling interest from SoftBank. The contract's terms stipulated that if Boston Dynamics did not go public within a 4-year window, SoftBank gained a put option to force Hyundai to buy its shares. If SoftBank declined, a reciprocal call option activated. Notice that both logical branches lead to the exact same outcome. Hyundai buys the stake. The contract legally locked the buyout price to the company's 2021 valuation of $1.1 billion. Hyundai perfectly insulated itself from any subsequent explosion in the firm's value. SoftBank's exit collapses the ownership structure. The cap table now consists entirely of internal Hyundai affiliates and Executive Chair Chung Ui-sun. Eliminating minority shareholder friction removes any external requirement to prioritize short-term tech demonstrations. Hyundai now has total executive control to force Boston Dynamics down a strict industrial manufacturing roadmap. Between the signing of that contract and its execution, the market value of Boston Dynamics surged 24-fold. This was driven by a complete overhaul of the company's hardware and software. The legacy version of the Atlas robot was a hydraulic research platform, impressive for lab demonstrations, but too complex and loud for sustained factory work. This wireframe details the new, fully electric Atlas. It features 56 fully rotational degrees of freedom, sustained 30-kilogram payloads, and autonomous battery hot swapping. Next, a new cognitive software architecture was added, establishing a strategic partnership with Google DeepMind. DeepMind provides vision, language, action foundation models. This introduces embodied reasoning, allowing the robot to process multimodal inputs like camera feeds and natural language, replacing brittle, step-by-step manual coding. The VLA model grants the robot real-time spatial awareness. It can read analog plant equipment, identify incorrectly oriented objects, and use visual feedback for success detection, evaluating if a physical manipulation task was completed correctly. Because the system runs on a unified software foundation, a physical skill mastered by one robot is instantly uploaded to the cloud and shared across the entire operational fleet. By pairing mass-producible electric hardware with DeepMind's Pymantics models, Boston Dynamics transitioned from an R&D cost center into a hyper-scalable industrial asset. That industrial asset is now entering the commercial deployment phase on the factory floor. Boston Dynamics has committed its entire 2026 production run to early adopters like Hyundai's Georgia Meta plant, with a mandate to scale manufacturing to 30,000 Atlas units annually by 2028. This graphic illustrates the commercial pricing strategy. Boston Dynamics is targeting an initial unit cost of under $320,000. That specific figure is deliberately calculated to sit below the loaded 2-year cost of employing 2 human U.S. manufacturing workers. The objective is to permanently shift human labor out of the operational expense column, where it is vulnerable to wage inflation and turnover, and turn it into a fixed capital expenditure for repetitive assembly tasks. By owning the robotics firm outright, Hyundai captures those capital expenditure savings directly on its own assembly lines, while positioning itself to absorb the profit margins from all future sales to other manufacturers. The economics of the assembly line only explain the operational side of this buyout. The ultimate objective addresses a structural crisis at the highest levels of the Hyundai conglomerate. This map diagrams the 4 circular investment loops binding the Hyundai chaebol together. These multi-tiered cycles all converge on a single holding entity, Hyundai Mobis. The critical weakness is ownership concentration. Executive Chair Chung Ui-sun holds only a 0.33% stake in this central hub. To officially secure his succession of the empire from his father, Chung faces an impending financial burden of tens of billions of won in legacy inheritance taxes. This is where the cap table consolidation becomes crucial. Following the SoftBank buyout, Chung personally owns a massive 25.02% equity stake in Boston Dynamics. With full corporate control secured, the buyout clears the path for an accelerated NASDAQ IPO for Boston Dynamics, projected for 2028. This public listing provides the personal liquidity Chung requires to pay inheritance taxes and purchase controlling stakes directly in Hyundai Mobis. The robotics acquisition is ultimately a massive financial mechanism engineered to dismantle Hyundai's vulnerable circular shareholding structure and cement Chung's dynastic control. By leveraging a meticulously structured options contract, Hyundai captured the full upside of the physical AI boom for pennies on the dollar. The automaker secured a proprietary robotic workforce to aggressively compress its operational costs, while simultaneously generating the capital required for its corporate succession. Executing this roadmap requires scaling manufacturing to 30,000 units annually and navigating inevitable friction from South Korean labor unions as human workers face displacement. However, Hyundai's vertically integrated approach creates a stark contrast with competing manufacturers, who are forced to merely purchase third-party robots to stock their assembly lines. Hyundai has consolidated financial options, physical AI unit economics, and dynastic succession into a single cohesive corporate mechanism.